35% tariff is now in place on some Canadian goods. And one Canadian industry that Washington has taken particular issue with is dairy.
In early August 2025, President Donald Trump took another step in his aggressive trade strategy. He raised tariffs on Canadian non-USMCA goods from 25% to 35%, escalating tensions at the border. Although the dairy sector itself is not directly hit by these new tariffs, Canada's dairy supply management system has long been a thorn in Trump's side. For years, he has portrayed it as an unfair barrier that protects Canadian farmers while limiting U.S. access to the market. Now, with broader tariffs in place and trade talks under strain, the question is whether Trump can force change in a policy Canada has vowed to defend at all costs.
Supply management is designed to protect dairy farms. There are limits to how much Canadian dairy farms can produce and how much from the United States can be imported to Canada.
Canada's supply management controls how much dairy is produced domestically and how much foreign product can enter the market. Imports from the U.S. are capped at roughly 3.5% of Canada's dairy market. If that limit is exceeded, tariffs skyrocket: 241% on milk and nearly 298.5% on butter, according to the Canadian Border Services Agency. The system has been in place for over 6 decades, designed to keep prices stable and protect thousands of family-run farms from being outcompeted by massive U.S. operations that can house tens of thousands of cows.
The dairy industry falls under CUSMA regulations, but U.S. President Donald Trump has repeatedly complained, saying it's an unfair deal for his country's producers.
From Washington's perspective, this is the very definition of a trade barrier. American producers already send about $800 million worth of dairy products to Canada annually, while Canada exports roughly $300 million in dairy south of the border. To Trump and his allies, the limits, and the high tariffs beyond them, mean lost opportunities for U.S. farmers. Just weeks before these latest tariff increases, Canada's Parliament passed legislation that forbids using supply management as a bargaining chip in future trade negotiations. The bill enjoyed cross-party support, with advocates pointing to past trade deals where portions of the market were conceded despite political promises to protect it. Now, any government that wants to change the system would have to repeal the law and pay a steep political price. This protection isn't just about Quebec, the heartland of Canadian dairy. Farmers in British Columbia, Alberta, and even the Northwest Territories see supply management as essential for economic stability. It's a rare national consensus in an often divided political landscape. Canadian officials, including Prime Minister Mark Carney, know what's at stake. Loosening supply management too far could allow foreign dairy to take up to 18% of the domestic market, a level that industry groups warn would undermine the system entirely. That could mean farm closures, job losses, and declining rural economies. Beyond defending dairy, Canada has leverage of its own. The U.S. relies heavily on Canadian energy, critical minerals, and integrated auto supply chains. These sectors give Ottawa bargaining power that extends far beyond milk and butter. In trade talks, it's not just about defending one industry. It's about maintaining a balanced, mutually beneficial agreement. Trump may have expected the same playbook to work here as it has elsewhere: apply tariffs, demand changes, and secure a quick win. Instead, Canada's legal safeguards and political unity have slowed the process to a crawl. The dairy sector remains protected, with Ottawa signaling it is ready to walk away from a bad deal rather than concede on supply management. Meanwhile, U.S. dairy producers still face oversupply, volatile prices, and stiff competition abroad. Higher tariffs on other Canadian goods risk hurting American importers more than they help U.S. farmers, a reminder that not every bluff works in Washington's favor.
We're going to be putting a very large tariff on chips and semiconductors. If you're building in the United States or have committed to build, without question committed to build in the United States, there will be no charge.
In the days after August 1st, the trade battle between Washington and its key partners took an unexpected turn. President Donald Trump pushed forward with one of his most aggressive proposals yet: a 100% tariff on imported computer chips and semiconductors. His message was blunt: build in the United States or pay double. This was more than a new trade policy. It was a move that sent tremors through global supply chains, rattled the markets, and left allies like Canada watching closely. Chips aren't just inside laptops. They're in cars, refrigerators, and the everyday devices people rely on. A shock at the source means higher prices across the board.
President Trump and Apple CEO Tim Cook just announced a new $100 billion commitment to manufacturing in the U.S.
The reality is that Apple invests billions per year already in the U.S., right?
And while Cook didn't announce the Made in USA iPhone that Trump maybe wanted, he did flatter Trump by giving him a customized plaque with a 24-karat gold base, of course.
Trump staged the chip tariff rollout with Apple's $100 billion U.S. investment as the showcase, while pressuring Intel's CEO and signaling that political alignment mattered as much as business. Many such investments were already planned, making the tariff more a political bargaining chip than a genuine industrial policy. On paper, the plan was about bringing money and jobs back to America. In practice, the economics tell a more complicated story. Independent studies, including the Yale Budget Lab's August 2025 review, estimate that tariffs implemented this year could raise household costs by $2,200 to $3,800 annually. That's because tariffs don't stay on corporate balance sheets. They show up in the final price tag for consumers. And while Trump points to corporate investments as proof of success, many of these projects predate the tariff. Apple's $100 billion pledge, Samsung's Arizona expansion, TSMC's multi-billion-dollar fabs, all were in motion thanks to the 2022 CHIPS Act and the AI-driven race for capacity. The tariff may have reinforced these moves, but it didn't create them. There's also the jobs question. Modern semiconductor fabrication is highly automated. Even with new facilities, the number of direct manufacturing jobs created is limited, and the work often requires specialized skills, narrowing the employment impact. In reality, most of these investments were already planned for strategic and technological reasons, with the tariff acting more as a political lever than the true catalyst.
John, these sound like bully tariffs. Auto, for example. Kiss the ring or face the tariff seems to be the message.
Yeah, bring a 24-karat gold plaque to the White House, or the tariff story could go on. And obviously that's a complicated story for companies and countries like Canada as well.
For Canada, the chip tariff was another reminder that Trump's trade pressure can target any sector. Prime Minister Mark Carney's response has been deliberate. Maintain the backbone of the Canada-US-Mexico agreement, which still keeps about 85% of Canadian exports tariff-free while refusing to rush into any bad deal. Ottawa has rolled out a $1.2 billion Canadian dollars support package for industries already hit by the August 1st increase on non-customer goods, shielding sectors like softwood lumber from immediate damage. On technology, Canada is deepening partnerships outside the U.S. while staying embedded in North America's semiconductor supply chain. This dual track reduces risk if the U.S. imposes the full 100% chip tariff without broad exemptions. Ontario Premier Doug Ford has warned that Trump could move to reopen CUSMA early, but Canada's united stance has been to prepare, not panic. The strategy is to engage on favorable terms, not from a position of weakness.
Hit that guy back as hard as we possibly can, and that's what we need to do. And we can do it. We can build anything here in Canada, absolutely anything.
The 100% chip tariff is more than an economic measure. It's a negotiating tactic, a show of force, and a test of loyalty. But it also carries the risk of higher consumer prices, distorted investment incentives, and unresolved technological gaps. Trump has made himself the central actor in this drama, but Canada has not been cast as a passive player. Under Carney's watch, the country is protecting its industries, diversifying its alliances, and holding its ground in trade talks. The fight over chips is just one front in a broader contest of leverage. And in that contest, endurance, not speed, will decide who comes out ahead.
Following the Swiss president's failure to reduce tariffs on her country after a visit to Washington earlier this week, the Financial Times is reporting that the U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
In early August 2025, Washington sent a jolt through the global markets. President Donald Trump's administration confirmed a 39% tariff on imported gold bars, hitting Switzerland, the world's largest gold refining hub, head-on. It wasn't just a blow to a small European country's exports. It was a message. No commodity, however entrenched in global trade, is beyond the reach of Trump's tariff playbook. For Canada, watching from across the border, this was a clear warning. If gold can be pulled into the fight, so can other high-value sectors.
The only thing I can tell you from a European perspective right now is that all shipments are on hold. So basically there's no trading of gold bars between the Atlantic.
Until the first week of August, traders believed bullion would be spared. Gold bars in the 400-ounce form for central banks, the 100-ounce size traded on COMEX, and the 1-kilogram standard used in Asia were assumed to be outside the scope of tariffs. That changed when a Swiss refiner received a formal letter from U.S. Customs confirming that under tariff code 7108-13550, these bars would face the full 39% duty. The immediate impact was severe. Gold shipments between the U.S. and Europe halted overnight. U.S. gold prices climbed above European levels, opening an arbitrage gap. According to U.S. trade data, imports had surged earlier in 2025, 43 metric tons in January alone, nearly double the average monthly U.S. refining output of 22 tons, as buyers tried to front-load shipments before any policy change. Now, those stockpiles are all that's left to bridge the supply gap. For the global gold market, this was more than a price shift. It was a sudden rupture in the supply chain. For Canada, the lesson is straightforward. Gold may not be a major export to the U.S., but the same logic could apply to Canadian strategic minerals, energy products, or even high-end manufacturing. Ottawa knows that even sectors long considered safe under USMCA can be targeted. The gold shock proved how quickly decades-old trade flows can be disrupted by a single enforcement letter. And with Trump's focus on bilateral trade imbalances, Canada's own surpluses in certain commodities could attract the same kind of attention Switzerland just received.
We have a lot to do in this country. We have a lot positive to do in this country, building this country in a way, building one Canadian economy.
I have all the confidence in the world in the Prime Minister. Donald Trump is very, very hard to deal with just because it's so fluid.
This is why Prime Minister Mark Carney's approach carries even more weight in the current climate. While Ford hits back publicly with numbers, Carney is quietly keeping negotiation channels open, even as Canada faces the 35% rate. He is deepening trade cooperation with Mexico, expanding links with the EU, and safeguarding domestic industries against sudden U.S. policy shifts. Canada's leverage lies in what the U.S. needs: strategic minerals, energy, and integrated automotive supply chains. The gold tariff episode only reinforces Ottawa's push to diversify export destinations and prepare contingency plans. From steel and aluminum to copper, and now gold, Trump is targeting sectors where the U.S. can exert maximum short-term leverage. The element of surprise keeps opponents off balance. It's a tactic designed to push trade partners toward concessions before they can rally a coordinated response. But with Canada, the strategy has met resistance. Carney and Ford are aligned in rejecting a bad deal and in showing that Canada will not simply absorb U.S. pressure without a counterplan. For Canada, the gold tariff is more than a dispute with Switzerland. It's a warning shot. Ottawa is combining public pushback with measured diplomacy, signaling it won't be outmaneuvered. The contest is no longer about who can raise tariffs higher, but about who can adapt faster to the shocks still to come.